The FASB and ISB recently issued its final standard on revenue recognition. And the standard affects different industries in different ways, and believe it or not, there are actually some impacts on retail organizations as well. My name is Brian Schilb, and with me today is Shoshana Feldman. We're in KPMG's Department of Professional Practice, and this podcast is going to focus on the impact of the revenue standard on retail companies. The core principle of the revenue standard is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. To achieve that core principle, the standard establishes a 5-step model that an entity would apply. First, identify the contract with a customer. Second, identify the performance obligations in the contract. Next, we determine the transaction price, and then allocate that transaction price to the performance obligations. And finally, we recognize revenue when or as a performance obligation is satisfied. So, Shoshana, can you talk to us about some of the issues affecting retail organizations?
Sure, Brian. Some of the issues affecting retailers are going to be identifying the number of performance obligations in their transactions and the contracts with customers. There are instances where retailers offer to their customers free or discounted future products. The retailers will need to assess whether those products represent material rights to their customers upon entering those contracts, and if so, they will need to assess whether to account for them as separate performance obligations. Under current U.S. GAAP, retailers generally account for these incentives as expenses, while others may defer revenue. If the retailer identifies that the performance obligation offers a material right to their customer, they will need to allocate the transaction price to those performance obligations.
So, Shoshana, let me give you an example. Let's say that somebody comes in and they buy a sweater for $100, and they also get a 20% off coupon, and the company is not giving any other discounts to any other customers other than those who come in and bought something. And so we determine that that's a material right. How would I allocate the $100 between the product and the 20% off coupon?
Well, Brian, the entity would need to estimate the standalone selling price of that voucher. The company needs to assess the average customer ticket price and the expected breakage for the use of that voucher.
So in other words, if the average ticket price is $100 and you're going to get 20% off, that might be about $20. And then if you determine that only 50% of them will be redeemed, that takes your standalone selling price down to about $10.
So you would need to allocate, based on a relative standalone selling price, the value of that voucher from the $100 transaction price to the voucher and the merchandise that was purchased.
Right. So in other words, if the standalone selling price of a sweater is $100 and the voucher is $10, based on your estimation that you took us through, you take that $100 that you received and you may end up with an allocation of, say, for example, $93 to the sweater and $7 to the voucher. I'm not sure if that's the right math, but that's what you're getting to.
Yes, that's right, Brian.
All right, let's move to consideration payable to a customer. Maybe you could talk about that for a minute.
Generally, when a retailer gives consideration to their customer, it is not in exchange for a distinct good or service. The consideration given to the customer would be a reduction to the transaction price in the contract.
Right. So and you'd have to consider whether or not you're receiving a distinct good or service. But I would agree that generally when a retailer pays cash to a customer, it may be a rebate or something like that, and they're probably not receiving a distinct good or service back from the customer that they would need to account for.
Gift card breakage. So when a retailer provides a gift card to their customer, they need to estimate whether the amount of the gift card will be fully used, or if they can estimate the proportion of breakage that they will experience with that.
Yeah, and I would say one thing that could be a potential change is today under existing GAAP, companies just try to determine whether or not they have enough data to be able to make an estimate. On a go-forward basis, they'll need to think about the constraint on variable consideration. So you'd only recognize some of that breakage, assuming it's probable that recognizing that breakage won't result in a significant revenue reversal.
That's correct. So a retailer will need to review their data. If they have enough data to estimate that pattern of redemption, they will be required to put into their revenue recognition an estimate of that proportional recognition for breakage. If they are not able to estimate that pattern of recognition, they will wait until the redemption of that balance is remote or the gift card expires, which is similar to our current guidance.
Okay, now let's talk for a minute or so about warranties. Can you cover warranties for us?
Under the new standard, there are two types of warranties. Assurance-type warranties are warranties that the product that we sell is going to perform as we have agreed to. A service-type warranty under the new standard is a promise to deliver a service, which under the new standard would be a separate performance obligation.
Right, and so a good example there might be a retail company sells a TV and also offers a separately priced extended warranty. And because, as you mentioned, optional warranties are separate performance obligations, the entity would have to estimate the standalone selling price of the primary product, also estimate the standalone selling price of the warranty, and then take the transaction price and allocate it to on a relative standalone selling price basis. Let's now move to rights of return.
Under the right of return, the entity needs to consider the constraint on variable consideration. When recognizing revenue, they have to estimate the amount to the extent that it is probable that a significant reversal in cumulative revenue recognition will not occur.
Okay, and then how about gross presentation on the balance sheet?
If you sell 100 products and you estimate that 90 of those products will not be returned, that remaining 10 needs to be accounted for on the balance sheet, both as an asset for the items that you believe will be returned and as a refund liability for that amount of that you have received from the customer.
Okay, so the change in practice there could be that gross up, as well as the constraint probable threshold on your estimate of returns. The effective date of the new standard for public business entities and certain not-for-profit entities is for fiscal years beginning after December 15, 2016, and interim periods within that year, and no early adoption is permitted for companies applying U.S. GAAP. So if you are a calendar year public business entity, your effective date will be 1/1/17. And for all other entities, there's a 1-year deferral. Keep in mind that there are some significant new disclosures required that may require new information to be captured in your systems. For transition approaches, there are some options. The first is applying the standard retrospectively. So if you adopt the standard on 1/1/17, you need to restate your 2015 and 2016 comparative periods. There are some optional practical expedients that you can apply if you choose to apply the standard retrospectively. An example would be applying hindsight to your estimates of variable consideration. The other approach is the cumulative effect at the date of adoption, and under this approach, you would adopt the standard on 1/1/17. You would not restate 2015 or 2016. If there's a contract that you entered into prior to 1/1/17 and you haven't recognized all of the revenue for that contract yet, you would apply the standard retrospectively to those contracts, and you have to disclose in the footnotes to the financial statements what 2017 would have looked like under old GAAP. With that, I'd like to thank Shoshana. I'd also like to thank our listeners for listening to the podcast. And for additional information, refer to KPMG's Financial Reporting Network, including the latest on the revenue recognition page, which links to KPMG analysis of the new standard, including defining issues, webcasts, and other podcasts.